You're a senior portfolio manager.
Yeah.
When you look at risk, how do you assess a risk like a Florence, and how does it relate to other risks you're trying to take into account?
Yeah, so great question. So first of all, the major impact for the small hedge fund industry that's focused on this will be in the reinsurers, right? So they had a very tough year last year because of Harvey in particular, and premiums did go up slightly, which created a lot of optimism, but they didn't go up that much. So this could have a big dent there. Fortunately, we don't have exposure. Another area that people don't focus on as much is on the agency CRT market. Those are credit risk transfer tranches that investors take at the bottom of the capital structure for new issuance. And so people forget that, you know, when you have big disasters, you do have some impact on housing, and not all of those losses are insured. And so you've eaten through some of the subordination in those tranches due to last year's hurricanes, and you're going to probably do that a little bit more because of Florence, unfortunately, which basically means you're taking a little bit more risk, so you need to be compensated more.
So how does that feed in, as Dave mentioned, to the broader risk market? I mean, we know this is coming, we know the areas it could hit. We know trade's coming.
Yeah.
We think we know the areas that we can hit.
Yeah, we think, yeah.
I mean, how do you deal with that when you're making shorter and longer term decisions?
Yeah, well, look, in terms of a hurricane or a natural disaster, it has to be incredibly large, something like Fukushima, to really have a meaningful impact on portfolio decisions that are based on 6, 12, 18 months. You know, again, in terms of trade, you want to make sure you're not in sectors or countries or regions that will be disproportionately punished by that path that's been laid out before us for quite some time.
But then you shouldn't be in U.S. equities in that case, right?
Well, look, U.S. equities benefit from a stronger economy in the U.S., stronger global economy. Their multiples are not excessive, but there will be some disappointment if the trade war escalates further. That being said, you know, you have had progress in NAFTA, right? You have had progress with Europe. So the question for U.S. investors now is, does China do we go full bore with China, right? Does it turn into a full-blown trade war? If so, obviously there's going to be an impact on tech in particular. There'll be a further impact on industrials. But what's the probability of that happening? Is it 20%, 25%? It's not 70, right? It's much higher than 5. So that's why it's very difficult in real time to evaluate how much that risk is priced in.
Okay, Troy Gayeski of SkyBridge was staying with us. So, Alex, the question is, do you really target U.S. companies that are particularly exposed to China?
Right.
Do you get that granular?
But you also brought the question up yesterday, is there asymmetric risk? That if we do get something done, is there enough negative news to be priced in that you will see a pop after that?
It could go the other way.
Right.
Yeah, you could have a run-up.
And again, so how do you hedge it,
it's
right?
clearly a headwind.
Well, certainly markets would be higher today if not for the trade rhetoric and the implementation of tariffs.
There you go.
200 to 300 basis points, not 500 to 700.